Most people think buying insurance is a smart move, but what if I told you that one simple choice could be the difference between retiring wealthy and struggling for the rest of your life? Today, we're diving into two of the most misunderstood financial products out there: term and whole life insurance. One is aggressively sold as a safe investment and a wealth-building tool. The other is often dismissed as a waste of money because you get nothing back. But here's the shocking truth: one of these options can make you significantly richer over time, while the other quietly drains your cash and benefits everyone but you. The scary part: millions of people choose the wrong one, not because they're careless, but because they were never shown the full picture. Let me be clear from the start: this video isn't sponsored by any insurance company, and I'm not trying to sell you a policy. My goal is to help you make smarter decisions with your hard-earned money. Insurance is important, but it's not the same as investing. Confusing the two is a huge financial mistake, and whole life insurance is often marketed as both, leading to poor results. Imagine two people with the same income and lifestyle, both wanting to protect their families. One picks cheap and simple term insurance. The other buys whole life insurance, convinced it's an all-in-one solution. Fast forward 30 years, one has built serious wealth and financial freedom, while the other is shocked to find their policy's returns barely beat inflation. This isn't a hypothetical story. It happens every day, and I'm about to break it down in a way no insurance agent ever will. So, let's start with term insurance. It's incredibly straightforward. You pay a premium for a specific term, like 10, 20, or 30 years. If you pass away during that term, your family gets a tax-free payout. If you outlive the term, the policy ends. That's it. It's pure protection, designed to cover your family when they need it most, like when you have a mortgage or young children. Because it's so simple, it's also incredibly affordable. Now, let's talk about whole life insurance. This one is more complex. It's designed to last your entire life, and it combines a death benefit with a savings component called cash value. A portion of your much higher premium goes toward the insurance, and the rest goes into this cash value account, which grows over time. Sounds good, right? An investment and insurance all in one. But here's the catch: the fees are incredibly high, and the growth on your cash value is often very low, sometimes barely keeping up with inflation. The real problem is the opportunity cost. That extra money you're paying for the whole life policy could be invested somewhere else, like in a simple index fund, where it could grow exponentially. Let's look at the numbers. A healthy 30-year-old might get a 20-year term policy for about $30 a month. A whole life policy with the same coverage could cost $300 a month or more. That's a difference of $270 every single month. If you invested that $270 in the stock market and earned an average return, you could end up with hundreds of thousands of dollars after 20 years. That's real wealth. With a whole life policy, your cash value would be a fraction of that. The strategy that builds real wealth is simple: buy term and invest the difference. Get the affordable protection your family needs with term insurance. Then, take the money you saved and invest it for your future. This way, you get the best of both worlds: protection for your loved ones and a powerful engine for building your own wealth. Don't let complicated products drain your financial potential. Thank you for watching. If this video helped you understand insurance better, please give it a thumbs up and subscribe for more financial tips. See you next time. Ever been confused by life insurance? Term? Whole life? What's the real difference? And which one is actually better for your wallet? Let's break it down. No jargon, just the straight facts. First, let's talk about term life insurance. Think of it like renting an apartment. You pay a small premium for a set period, say 20 or 30 years. If anything happens to you during that term, your family gets a tax-free payout. It's simple, affordable, and purely for protection. For example, a healthy 30-year-old might pay just $30 a month for a $500,000 policy. Its only job is to protect your loved ones if you're not around. Now, let's look at whole life insurance. This is more like buying a house. It's meant to last your entire life, and the premiums are much, much higher, often 10 to 20 times more than term insurance. Why? Because a portion of your premium goes into a savings component called cash value that is supposed to grow over time. Sales agents often pitch this as a great investment, a way to build wealth while being insured. But here's the crucial part: they don't always tell you. The growth inside these policies is often very slow, especially in the early years, and it's eaten up by high fees and commissions. That's a big reason why the agent is so eager to sell it to you. So, what's the smarter financial move? Let's run the numbers. Instead of paying $400 a month for a whole life policy, what if you bought that $30 term policy and invested the $370 difference yourself? Let's say you put it into a simple S&P 500 index fund. Over 30 years, assuming a conservative average return, that invested money could grow to hundreds of thousands of dollars, potentially far more than the cash value you have in your whole life policy. You get the same, if not better, protection for your family, and you build real wealth that you control, not the insurance company. So, the verdict? For the vast majority of people, term life insurance is the clear winner. It provides the protection you need at a low cost, freeing up your money to invest for your future. Whole life insurance often benefits the insurance company and the agent far more than it benefits you. It mixes insurance with investing, and it does both poorly. Don't let complicated sales pitches lead you down a path of financial regret. Buy term and invest the difference. It's one of the simplest and most powerful strategies for building long-term wealth. I hope this clears things up. If you found this helpful, give this video a like and subscribe for more honest financial advice. Thanks for watching. Whole life insurance, on the other hand, works very differently and is often misunderstood. Unlike term insurance, whole life insurance covers you for your entire lifetime and includes a savings or cash value component. A portion of your premium goes toward insurance, and the rest goes into a cash value account that grows over time. On the surface, this sounds attractive: lifetime protection plus savings in one product. But the problem lies in the cost and the efficiency. Whole life insurance premiums are as we come to the end of this discussion. The most important thing to understand is that becoming wealthy is not about choosing complicated financial products, but about clarity, discipline, and intentional decision-making. Insurance is meant to protect your income and your family, not to replace a proper investment strategy. When you strip away the marketing language, fancy charts, and emotional sales pitches, the difference becomes very clear. Term insurance gives you maximum protection at the lowest cost, freeing up your money to be invested in assets that historically grow faster and more efficiently. Whole life insurance, while it may sound comforting because of its guarantees and lifetime coverage, often sacrifices long-term wealth for perceived safety, making it suitable only for a very small group of people with highly specific financial needs. As we come to the end of this discussion, the most important thing to understand is that becoming wealthy is not about choosing complicated financial products, but about clarity, discipline, and intentional decision-making. Insurance is meant to protect your income and your family, not to replace a proper investment strategy. When you strip away the marketing language, fancy charts, and emotional sales pitches, the difference becomes very clear. Term insurance gives you maximum protection at the lowest cost, freeing up your money to be invested in assets that historically grow faster and more efficiently. Whole life insurance, while it may sound comforting because of its guarantees and lifetime coverage, often sacrifices long-term wealth for perceived safety, making it suitable only for a very small group of people with highly specific financial needs. Ever wonder why some people seem to get rich while others, who think they're being safe with their money, just tread water? A huge part of it comes down to understanding one simple rule: keep your insurance and your investments separate. Let's break down why this is so critical. Think of it like this. Insurance is your financial bodyguard. Its job is to protect you and your family from unexpected disasters like a house fire, a serious illness, or an untimely death. It's a shield. You pay a premium for that peace of mind, knowing that if the worst happens, you won't face financial ruin. Its purpose is purely defensive. Now, investing is your financial offense. It's how you build wealth. You put your money into assets like stocks, bonds, or real estate with the goal of growing it over time. This is where you let compounding do its magic, turning your initial capital into a much larger sum over decades. The goal of investing is to make your money work hard for you and get richer. So, where does the confusion come in? It comes from products that try to do both jobs at once, often called investment-linked insurance policies. They promise the safety of insurance with the growth of an investment. Sounds great, right? But here's the problem. When you mix the two, you usually get the worst of both worlds. First, the returns are often much lower than what you could get from a pure investment. Why? Because a big chunk of your money goes toward paying for the insurance component and high fees, not into the market to grow. These fees can seriously eat into your long-term gains, leaving you with a lot less than you expected. It's like trying to run a race with weights tied to your ankles. Second, you lose flexibility and control. These policies often lock up your money for long periods. Need cash for an emergency or a sudden opportunity? Too bad. Getting your money out can be difficult and expensive, with heavy surrender charges. With separate investments, you have much more control over your cash flow and can adapt to life's changes. The people who build serious wealth understand this distinction. They don't look for a one-size-fits-all solution. They buy term life insurance, which is pure, affordable protection, to cover their risks. Then, they take the money they saved and invest it aggressively in a diversified portfolio. This strategy allows their money to grow at its full potential while their family remains protected. So, if there's one thing you take away from this video, let it be this. Do not buy insurance hoping it will make you rich. Buy insurance to protect your family and invest separately to build your wealth. Before you sign any policy, ask yourself a simple question. Who really benefits from this, me or the person selling it? Making an informed choice today can save you from years of financial regret. If this video helped clear things up for you, please hit that like button, subscribe for more financial clarity, and share it with someone you know who's navigating these important decisions. Thanks for watching.